Welcome to part one of the EA Tax Training Enrolled Agent Exam Preparation course. My name is Tom Norton. I am both a certified public accountant and an enrolled agent, and I will be your guide and instructor throughout this course. Part one of the EA exam is all about individual taxation. We've got 7 videos for you in this part one. This first video you're watching now we call Overview and Getting Started. Video 2 is about income. Video 3 is about a special kind of income called capital gains. Then in video 4, we'll talk about adjustments to income and deductions. Video 5 is about calculating the tax and tax credits. In video 6, it's all about retirement and Social Security. And finally, video 7 is about specialized returns and topics. I look forward to guiding you through all of these topics. So without further ado, let's jump right into video 1, Overview and Getting Started. In this video, we are going to do an overview of the individual income tax return and the individual income tax system in general, and we'll talk about what you need to do in getting started to prepare a tax return for a client. Specifically, what we'll cover is an overview of Forms 1040 and 1040 SR. Then we'll talk about the sources of information you can use to get the data you need to prepare a return. Then we'll talk about the filing requirements, who even needs to file a tax return, and if they do, what are the due dates? And then we'll go into detail about the top section of the income tax return. Before we do that, we're going to talk about the free resources you can get at irs.gov. At the beginning of each of these videos, you'll see a slide like this that shows you those IRS publications, forms, and form instructions that relate to the topics covered in that video. And all of these are great, but I especially want to draw your attention to the top 3. Publication 17 is called Your Federal Income Tax. I consider this to be the textbook for part 1 of the EA exam, not just for this first video, but for all of part 1. And if publication 17 is the textbook, then the instructions for forms 1040 and 1040 SR are the workbook for part 1 of the EA exam. Now, this is just one set of instructions that covers both forms. It's not 2 different sets of instructions. But those 2 things together, publication 17 and the 1040 form instructions, will have most of the information you need for part 1 of the exam. You need to get those and read them and study them. Also, while you're there, you might as well get the forms themselves, especially Form 1040. Go ahead and look at Form 1040 SR. We'll look at both of these today as well. But become familiar with Form 1040. Look at each line and just understand what it's asking for and how the form flows. The rest of these publications are also great. They give you a deeper dive into some of these specific topics. So I highly recommend them as well. But if you're just going to default to a couple of them, go for those top 3. Here's a secret about the enrolled agent exam. It is that most of the questions come from IRS forms and publications. That's where they get the material for asking the questions. And so you definitely want to get those and study those. Okay, let's jump right in to our overview of the forms 1040 and 1040 SR. We'll start by talking about the flow of the tax return. So what we're trying to get to when we do a tax return is we want to know, does the taxpayer owe the IRS, or do they get a refund from the IRS? That's kind of the bottom line. But to get there, we need to go through several steps. So we start with gross income. Then we subtract what we call adjustments to income, and that leaves us with a very important number called adjusted gross income, or AGI. You're going to hear about AGI a lot because many sections of the tax code refer back to adjusted gross income. So you're going to want to become very familiar with that. From AGI, we subtract deductions, And there's three types potentially of deductions: standard deductions, itemized deductions, or something called qualified business income deduction, or QBI. That leaves us with taxable income. We then apply the tax tables or tax rate schedules to that taxable income to come up with an amount of income tax. But we're not finished yet. Some taxpayers will get tax credits that reduce their income tax. Some taxpayers will have to pay other taxes that increase the amount of tax. And then that leaves us with our net tax. From the net tax, we subtract any payments that were made. This could be as simple as withholding from your job that's shown on a W-2, or it could be estimated payments that the taxpayer made, or there's other types of payments that can be made. But when we subtract those payments from the net tax, that finally gives us our amount due to the IRS, or our overpayment, or what we might call your refund that is due from the IRS. So let's see what all of that looks like on the actual tax form itself. So this is page 1 of the 2023 Form 1040, and we will zoom in here so we can see it better. So you can see at the top, we start with kind of the basic information to get going. And then as we scroll down, you can see we've got dependents that might be listed. And then we get into income. So remember, the top part of our little chart, our flow chart there, was gross income. And so this starts with all the different types of income you can have. And then we have adjustments to income, which leaves us with line 11, which is adjusted gross income, or AGI, that very important checkpoint that we talked about. From that, you subtract the deductions. And then we're going to move on to page 2. And at the top of page 2, after we zoom in here, you can see you come up with your tax. Then you've got various tax credits, other taxes, and that brings us to our total tax. And then we have payments that were made by withholding or other forms of payments. Finally, that brings us down to either a refund, or an amount that was overpaid, or an amount that the taxpayer owes. And then we have this third-party designee part. This is a part where if the taxpayer agrees, they can check yes, and then you can put your name in here. And then if the IRS has a question about this tax return sometime down the line, then they will actually talk to you about it. They don't have to talk to the taxpayer. So that's kind of nice. And then at the bottom of page 2 of the return are the signatures. So the taxpayer is going to sign, and then you, as the paid preparer, are going to sign. So that is the 1040. Again, you're going to want to get your copy and go through that in detail. But there is another return that your clients potentially could file, and that is called the 1040 SR. The SR stands for seniors. So this is a return that is only for taxpayers who are age 65 or older. It is optional. They do not have to use it. All of the information, if you look at it, remember back to what we saw in the 1040, is exactly the same. It's asking for all of the same things. There are no differences in how the tax is computed. There's no differences in the deductions or the income or anything like that. If you use either form, you'll get to the same exact amount of tax, the same exact amount due or refund owed. The only real difference is that it is meant for older people, and so the font size is larger. That really is the only difference. Because the font size is larger, instead of being on 2 pages, it takes 3 pages to get to the same bottom line. They also add, for the convenience of the senior, this 4th page, which is just a chart of the standard deductions. The standard deduction amounts are not any different than they would be on the Form 1040. It's just that they're here as one page of the tax return for the convenience of the taxpayer so they don't have to go look these amounts up in the form instructions. Now, these days, most tax returns are filed electronically. The benefit of the Form 1040-SR is for taxpayers who are filing on paper because the font size is larger. So it's not really that relevant for most taxpayers. Now, to be fair, of all the tax returns that are filed on paper, it's safe to assume that a pretty good percentage of those is from folks who are 65 or older, because that's the way they've always filed and that they're used to filing. And so they're more likely to file on paper. But if you file electronically, for instance, if you as a tax preparer are using tax software, which of course you will be, then there's really no need for the Form 1040-SR, although you can still use it. But again, it is optional. So as we talk about the Form 1040 throughout this course, we could also mean the 1040-SR, but I'm not going to say 1040-SR all the time. I'm just going to say Form 1040, and you will know what I mean. So if you are going to prepare one of these returns, you need to get the information to do so. So what are the sources of that information? Well, the first source that you'll want to go to, and the best place to start in preparing this year's return, is by looking at last year's tax return. And if you are not the one who prepared last year's tax return, then you are going to want to ask the client for it. Now, if they can't find it, they don't have it, that's okay. You can still prepare the return, but it's just great to have it because first of all, it's going to have all the basic taxpayer information, name, address, social security numbers. Of course, you always want to verify that information. Things can change, but it's great to at least have it as a place to get going. It'll also help you to know what to look for this year's return, because a lot of times, they've got the same types of things each year. They had W-2s and 1099s for interest and dividends and things like that last year. They probably are going to have them again this year. There's also things that you really need prior year returns for. There's things called carryovers, things from one year that affect the next year, net operating losses, depreciation that take place over several years. So you need last year's return. And then once you're finished with this year's return, it's great for you and the client to be able to compare this year's return to last year's return. First of all, it can help you to find things you may have missed. And secondly, it's just kind of nice for you and the taxpayer to see what's changed, income, deductions, etc. Now, what if you're looking at that prior year tax return and you find an error? The previous preparer did something wrong. Hopefully it wasn't you, but it could even be you that did something wrong, or it could be another preparer. What is your obligation? Well, you must tell the client about it and explain the consequences about it. And even if it's small, still you want to tell the client. And then you want to tell them what's going to happen if they do or do not amend their income tax return. Now, of course, the error could go either way. It could mean that the taxpayer, if they were to amend their return to change it, would get a refund, or it could mean that they would end up owing money. So you need to just let them know that. So for instance, if they were going to owe money, you need to say, look, this would result in you owing money, and it's also going to result in interest and penalties that we'll talk about here in a little while. So you're going to end up owing not just the amount of the tax, but also interest and penalties for not paying that tax last year when you were supposed to pay it. On the other hand, if they're getting a refund, you'd say, hey, look, you're getting a refund. And not only would you get a refund of the money, but you would actually also get interest. Yes, the IRS will pay you interest if they owe you money from a previous period. So you just let them know that. Then at that point, it is up to the client to decide whether or not they want to amend the return. It's not your choice. It is the client's choice about whether to do that. And if they decide not to do it, then that's fine, that it ends there. There is confidentiality between you as a tax preparer and the client. So it's not your job to go tell the IRS that, hey, there was a mistake last year and this client didn't pay everything they were supposed to pay. It is the client's choice about whether or not they fix that error. Now, an error is different from an intentional, fraudulent type of situation. We'll talk about all those situations in part 3 of this course, but here we're just talking about routine errors that get made. People make mistakes. So it is the client's choice about what they do with that. Now, once you've looked at last year's tax return, what are other sources of information? Well, first of all, you should know about your responsibilities when you're looking at information that the client gives you. You are expected to do what we call due diligence for the information that the client gives you. Now, you do not work for the IRS. You are not an auditor. You are not going to ask for every receipt for every little expense they tell you about. That is not your job. What your job is to do is to be reasonable. The IRS will look and say, what would a reasonable tax preparer have done in this situation? So if someone presents to you information that seems perfectly normal and fine based on that taxpayer and based on their life situation, et cetera, and so forth, then that's fine. You don't have to ask them to prove it or give you a receipt or anything like that. But if they come to you with something that just doesn't really quite seem right, then you do have a duty to just to ask questions and possibly to ask for verification. Now, it comes to due diligence, there actually are a few things that the IRS will require you to dig a little deeper and to get more information and sometimes even proof. We'll talk about those as the course goes on. But except for those few things, in general, you're just looking for things that don't quite smell right. They don't pass this, what we call the smell test. So, for example, if you've got a 30-year-old with a job and they make $50,000 a year, they don't have any interest or dividends, or as far as you can tell, they don't have any large investments or anything like that, and they tell you that they made a $40,000 charitable contribution last year. Well, is it possible that that person did that? Sure, it's possible, but does it really pass the smell test at first blush? No, it really doesn't. So that'd be something that you'd probably want to say, oh, the IRS might set off alarm bells or red flags with the IRS. What was that $40,000 charitable contribution? Do you have a receipt or some proof of that? That's the kind of digging that you would want to do. So having said that, what are that information? What are kind of the categories that we would be looking at? Well, what goes on a tax return? Income, expenses, credits, sale of assets. And if somebody's selling an asset, they may have a gain or loss, but in order to know what that gain or loss is, you need to know how much they paid for that asset or what their tax basis is in that asset. And then there can be other things on the return as well. But let's talk about each of these categories and some of the items you might have as sources of information. So income, when we're talking about income, we're talking about worldwide taxable and non-taxable income. This can come from W-2s from a job. So you've probably had a job before. You probably got a W-2, so you know what I'm talking about. It shows your salary and how much tax was withheld, etc. There's also these Form 1099s. These are for income other than wages. So it could be interest from your bank or dividends from a brokerage account that you have. It can also be non-employee compensation. So if you do work for a company, but you're not an employee of that company, but they pay you, you might get a 1099. There are Form K1s that come from partnerships and S corporations and estates and trusts that show income on them that the taxpayer needs to report on their Form 1040. There could be just bank and brokerage statements that show income, and the taxpayer could have their own records. So the taxpayer may have a small business and they've got bookkeeping records or spreadsheets that they keep or receipts that they have. So those are possible sources of information about income. Next is expenses. For expenses, we've got Form 1098. So 1099s, we talked about, show income. 1098s show expenses. So for instance, if you have mortgage interest, then you get a Form 1098 from your bank or mortgage company each year. There's also 1098s for college tuition that was paid, and there are other 1098s as well. Form K1s, again, not only do they have income information, they can sometimes have expense or deduction information as well. And then receipts that the taxpayer may have, bank statements that can show amounts that were paid out, canceled checks, and again, the taxpayer's own records. Next, assets. So this again is going back to the cost or basis of those assets. For real estate, you could have closing statements. For stocks and bonds and mutual funds, you could have bank or brokerage statements. You could have forms that are issued to the taxpayer. So sometimes those 1099 or K1 forms or there's a form called 3922 that you might get from an employer about stock and stock options. These forms can also show cost or basis information for assets, and of course receipts that the taxpayer used for buying something or canceled checks. There can be appraisals of property that can come into play, and there could be other miscellaneous items as well. And then for other items on the tax return, there could be something as simple as a driver's license. If you have a taxpayer that walks in, you've never seen them before, you have no idea who they are, there's a lot of tax and identity theft fraud that goes on. So you're going to want to know who they are. So you're going to want to ask for at least one form of official identification, if not more. So you want to see a driver's license. There can be school records that come into play. So if you've got a child, one of the ways to prove that they got a child and what their age is records from the school. There could be letters that the taxpayer received from the IRS. So maybe they filed their return last year and the IRS found an error and sent them a letter and said, hey, we found this mistake and we've made adjustments to your returns. So now your income is this and your adjusted gross income is this and your taxes are this. You need to see that letter or any letter that the taxpayer may have gotten from the IRS. And then there could be other things as well. So now that we've talked about the sources of information, let's talk about filing requirements and due dates. So first, who needs to file a tax return in the United States? Any U.S. citizen or resident of the United States or Puerto Rico who meets the filing requirements, which could be based on income or other. So again, who has to file? Any U.S. citizen or resident of the United States or Puerto Rico who meets the filing requirements. That's who need to file an income tax return in the United States. So we're going to talk first about those income requirements. And before we do that, we need a couple of definitions. You're going to see these terms, and so you want to at least have a decent idea of what they mean. Gross income means all income received in any form, the form of money, goods, property, or services that is not exempt from tax. So this includes income from sources outside the United States as well as inside. If you sell your home, it includes the proceeds from selling your home. It's the taxable portion of Social Security benefits. It's any business income you've got, but not business losses. And it includes capital gains. That's gains from selling certain types of property, but not losses from those sales. So all of those things are considered gross income. So if it is not exempt from tax, it is included in gross income. Then we also have earned income and unearned income. Earned income is what it sounds like for the most part: salaries, wages, tips, professional fees, income from a business that you work in. It also includes scholarships and grants, which may not intuitively seem like earned income, but it is considered earned income. And then unearned income is everything else. If it's gross income and it's not earned income, then it's unearned income. So it's interest, dividends, capital gains, even unemployment compensation because you didn't actually work for it, taxable Social Security and pensions. You did kind of work for it in the past, but you didn't work for it in this year. And so it's considered unearned income now, and income from annuities or distributions of unearned income from trusts. So when you see those terms, that's what they mean. So then we're going to go to this chart. This chart is straight from publication 17, your federal income tax, that we talked about. And so it says, depending on what your filing status is, and we're going to go into detail about these in this video, but for now, just accept them for what they are. These are the 5 filing statuses. And depending on what your filing status is and your age, then this is the amount of income over which you must file a tax return. So, for example, if your filing status is single and you are under age 65, then if your gross income is at least $13,850, then you need to file a Form 1040. If you're 65 or older and single, that amount goes up to $15,700. And then you can see the amounts for the other filing statuses. Married filing joint under 65 is $27,700. Not coincidentally, that is twice as much as the single amount of $13,850 because there's 2 people instead of 1. You can see here, if you're married filing separately, then you have to file if you have at least $5 of gross income. So basically, if you're married filing separately, you have to file the tax return. Head of household is $20,800 if you're under 65. Qualifying surviving spouse is $27,700. Not coincidentally, that is the same amount as married filing jointly, because as we'll see later, the qualifying surviving spouse gets the benefits of married filing jointly, even though their spouse has passed away. Now, you can see at the top of this chart, it says this is the filing requirements for most taxpayers, not for everyone. So, who are the taxpayers it does not apply to? Well, that would be taxpayers who are able to be claimed as a dependent on someone else's tax return. So, for instance, the 16-year-old child who has a job, they're a dependent on their parents' tax return, but they've got income. So, do they need to file a tax return? So, let's zoom in here so we can see it a little bit better. So, if someone is single, they're a single dependent, meaning they are not married, and they can be claimed as a dependent on someone else's tax return. So the first question is, were you either age 65 or older or blind? If the answer is no, so this might be that teenage child, they're not 65, they can be claimed as a dependent, they're not married, then they must file a return if any of these apply. If their unearned income, interest, dividends, etc., was more than $1,250, then no matter what these other categories are, they must file a Form 1040. If their earned income from a part-time job or what have you, or a business, if it was more than $13,850, then they need to file. Or if their gross income, which is a combination of earned and unearned income, is more than the larger of $1,250 or their earned income plus $400. And it's their earned income up to $13,450, then you would add the 400, which would get you back to their $13,850 that's shown up here. So this last category I know it sounds a little bit confusing. It's just trying to catch people who fall into an in-between category. They want to make sure that they also report. So just take it for what it is for now. Unearned income of 1,250, earned income of 13,850. Those are the main numbers you need to remember. And then you do just want to be familiar with this. If their total of their earned and unearned income, or their gross income, is more than the larger, or which of these two is bigger, 1,250 or their earned income plus $400. In any of those cases, they must file a 1040. Now, this next box is yes. That means they are single, but they were age 65 or older. So this might be an elderly parent who is the dependent of one of their children, for instance. If in that case, they have to file a return if their unearned income is more than $3,100, or it's a larger number if they're both 65 or older and blind. They also have to file if their earned income is more than $15,700. And yes, people age 65 or older can have earned income. And then they've also got a similar deal here with their gross income is more than the larger of it's $3,100, or their earned income plus $2,250. So that is for single dependents, unmarried people who can be claimed as a dependent on someone else's return. The bottom part of this chart is for married dependents. So they can be claimed as a dependent in someone else's return, but they themselves are married. This isn't very common, but it does happen, especially when we get into the age 65 or older. But the first question again is, were you age 65 or older? And if the answer is no, then the amounts are exactly the same as they were up above, with one exception. But you can see unearned income 1,250, earned income of 13,850, and then the gross income is the larger of those two numbers. There's one extra category though here. If they are married and filing a separate return, then if their gross income was at least $5, remember that from the previous chart, was at least $5, and their spouse files a separate return and itemizes deductions, then they have to file a return as well. Okay, so that is for a married dependent who is under age 65. If you have a married dependent who is over age 65, so this could be mom and dad are both dependents on a child's tax return, as an example. Then, if their unearned income was more than 2,750, and that is different, it is a different amount than up above. So if their unearned income was more than $2,750, earned income was more than $15,350, the same rule about $5 if your spouse files separate and itemizes. And then they've got, again, another chart about the gross income. The gross income is more than the larger of the 2,750, or the earned income plus $1,900. So let me tell you another little hint. You will get questions that cover the information on this chart. There will be questions about such and such a taxpayer has this much money from a job. Do they have to file a return? Most of the time, they're going to be fairly straightforward. They're going to be focusing in on this $13,850, or they're going to go back on the previous chart. They're going to focus on the 13,850 here, or on the 27,700 for the married filing jointly. They're not usually going to get into the more kind of obscure cases, such as they're married and they're over 65 and blind. I'm not saying you should ignore those numbers, but I'm saying if you're going to do your studying, focus your studying on kind of the more common situations that you would find. Now, I mentioned before that income is not necessarily the only thing that could cause you to file a return. There can be other reasons that, regardless of your income or at income levels much lower than we've seen on these charts, that you could have to file a return. So that's what we're going to look at now. So even if you don't meet the income requirements we just talked about, if you owe any of these special taxes that are listed, then you will have to file a return. There's something called the alternative minimum tax that you'll learn about in another video. If they owe that, then it doesn't matter how much their gross income is or their earned income or anything else, you have to file a return. There are these special taxes on retirement plans, household employment taxes that they may have to pay, that if they do, they have to file a 1040. Social Security and Medicare taxes on tips that were not already reported, you have to pay. Uncollected Social Security and Medicare taxes on tips, and some other, group term life insurance, and additional taxes on health savings accounts. They would still have to pay those and file a return. And then there's something called recapture taxes, especially depreciation recapture. If they owe that, then they have to file a Form 1040. So any of those, again, you want to be familiar with that list. Then if the taxpayer, their spouse, gets a distribution from these special kind of health savings accounts, then they would file a return regardless of their gross income. And then number 3, this is an important one. You're likely to get a question about this on the exam. If the taxpayer had net earnings from self-employment of at least $400, then they need to file a return. Net earnings from self-employment means you take your gross earnings from self-employment, so how much income you received, and then you subtract the related expenses. That is your net earnings from self-employment. And if it's at least $400, you're going to owe something called self-employment tax. And since you're going to owe that tax, you have to file a Form 1040. This next category is wages for some church employees that are exempt from Social Security and Medicare. If they have $108.28, yes, you read that right, that is the amount. So just that amount, if you see that on the exam, it'll probably pop out at you. You can remember $108.28, church, and you'll be able to get the right answer. If the taxpayer received advance payments of the premium tax credit, then they have to file a return. This is for these Obamacare or ACA plans. Sometimes taxpayers at certain income levels might receive advance payments on the premium tax credit, and if they do, they have to file. And then this last one is really obscure. I wouldn't worry about it. It's about deferred foreign income from Section 965. I guess just remember the 965, but you're not likely to get a question about that. So let's do a couple of examples so you can see how these rules work. Joey is 21 years old, single, and cannot be claimed as a dependent on anyone else's tax return. In 2023, he earned $10,000 at a part-time job. He had dividend income of $2,500, interest income of $1,000. Does he have to file an income tax return for 2023? What do you think? Well, let's think about it. What's his income? Remember, we have this income test, and he's single. His income is $10,000 plus $2,500. That's $12,500 plus $1,000. That's $13,500. So his gross income is $13,500. He can't be claimed as a dependent on anyone else's tax return. So it's his gross income that we're interested in. It's $13,500. What was the magic number for a single taxpayer under age 65? That's right. It was $13,850. So Joey does not make that much. So Joey does not have to file a Form 1040 for 2023. Now, can Joey file a 1040 for 2023? Yes, he can if he wants to. Now, you might say, why would somebody file a return if they don't have to? And the reason is because of that part-time job. If they withheld income tax from him for that part-time job, well, he wants to get it back. He doesn't owe any tax. So even though he didn't make $13,850, he is allowed to file a return to get that refund back. But if they did not withhold tax, then he doesn't have to file and he's got no reason to file. Example 2, Monica is 21 years old, just like Joey. She's also single. She also cannot be claimed as a dependent on anyone else's tax return. She also earned $10,000, but she earned it in her grass cutting business. She also has dividend income of $2,500 and interest income of $1,000. Does Monica need to file an income tax return for 2023? What do you think? Well, at first blush, seems like everything is the same as Joey. Exact same amount of income. She's single. She can't be claimed as a dependent. So you would think maybe, no, she doesn't have to file. But I'm sure you are sharp enough to figure out that there is a difference here. And that is that the $10,000 that she earned was not from a part-time job. It was in her own business. It was in a grass cutting business. Remember, if you have at least $400 of net earnings from self-employment, then it doesn't matter how much your gross income is, you must file a Form 1040. So Monica is not going to owe income tax because she's got less than $13,850 of gross income. But she is going to owe self-employment tax, and she must file a 1040 in order to report it and pay it. Now let's move on to filing deadlines. When is a tax return due? I bet you already knew the answer to this one. The tax return is due on April 15th. Now, for the EA exam that you're taking in 2024, we're dealing with the 2023 tax year. So that's what we're going to be talking about in these videos. And the 2023 tax return is due on April 15th, 2024, unless the taxpayer lives in Maine or Massachusetts. Then it was due on April 17th. Why? Because the general rule is that the individual income tax return is due on the 15th day of the fourth month following the end of the tax year, which is usually April 15th. But if April 15th falls on a weekend or a holiday, then it gets pushed back to the next business day. Well, Maine and Massachusetts have got some holidays in there. So for those two states, it is April 17th. But for the rest of the country, is due April 15th. And again, different years, April 15th might fall on a Saturday or Sunday or on a holiday for everybody. And so in that case, it would get pushed back to the next business day. You can get an extension of time to file. So if it comes to April 15th and you don't have all the information you need, or you just haven't gotten around to doing it, you don't have to have a good reason or anything like that. That's why it's called an automatic extension, because you don't have to have a reason to do it. If you file this form by April 15th, this form 4868, you can get an extension to file until October 15th. It's a 6-month extension to October 15th of 2024. But you do have to file the 4868. It is automatic, but that doesn't mean you don't have to do anything. You have to file the form. It just means that they're not going to ask any questions and they're going to automatically grant you that exemption. But the extension of time to file is not an extension of time to pay. If you are going to owe, you have to pay in your money with your Form 4868. You might say, but Tom, how am I supposed to know how much money I'm going to owe? I haven't even looked at it yet, or I don't even have all the information I need yet. And the answer is you need to do the best you can. You need to do an estimate of what you think you might owe. And if you don't pay it in, then you're going to owe interest and penalties, as we will be talking about shortly. So an extension of time to file is not an extension of time to pay. You will certainly get one or more questions that deal with that topic on the EA exam. Now, there's some exceptions to filing by April 15th. If you
are a U.S. citizen or resident and you are living outside of the United States or Puerto Rico, and your main place of business or post of duty is outside the United States or Puerto Rico, or you're in the military outside the United States or Puerto Rico, then you get an automatic 2-month extension to June 17th. And this one really is automatic. You don't have to file the form in order to get it. So be careful when you look at this. You have to be a U.S. citizen or resident, and you're living outside of the U.S. and you're working outside of the U.S. This is not just that you're on a European vacation that you don't have to file till June 17th. This is not even that you're in Europe or wherever, you're in Australia for work. That doesn't matter unless your place of business is in Australia or wherever and you live there. So you have to live there, and it has to be your main place of business in order for this automatic 2-month extension to apply. But if it does, then you don't even have to file the form. You get an extension to, well, it would be June 15th, but June 15th is on Saturday, so it's June 17th of 2024. It is still not an extension of time to pay. So if you are going to owe, then you need to pay in, and usually you can just do that by filing the Form 4868 by April 15th, even though you're not required to get this extension. If you owe, you got to pay the money in. So you can do that, and you don't have to file the 4868 to make the payment, but it's probably easiest just to go ahead and file the 4868 by April 15th, and then you'll go ahead and get the extension to October 15th. Let's say you're not going to owe, but you want an extension to October 15th. Well, then you can file the 4868 by June 17th, and you will get an extension of 4 months to October 15th of 2024. Another exception to the April 15th deadline is if you are in a presidentially declared disaster area, then you will get an extension of time to file and pay. So they say, hey, you've got enough problems going on in your life right now. We're going to actually give you an extension for both filing and paying. And this is for individual and business taxpayers who live in the disaster area, whose tax records are in the disaster area, and relief workers who are working in that disaster area. There's also an exception for both filing and paying for those who are serving in a combat zone as designated by the president. They get an extension of 180 days from the later of your last day in the combat zone or your last day in the hospital due to an injury sustained in the combat zone, plus the number of days before April 15th of 2024 that you were in the combat zone. So, for instance, if the person was in the combat zone starting in 2023, and then they didn't leave the combat zone until the summer of 2024, that means they were in the combat zone from January 1st, 2024 to April 15th of 2024. So let's say they came out of the combat zone on July 1st of 2024. They would get 180 days from July 1st of 2024 plus 3.5 months because they were in the combat zone all the way through April 15th of 2024. So they would actually get 180 days is about what, 6 months? So they would get 6 months. You have to actually count the days. It's not exactly 6 months, but you get 180 days from July 1st. Well, that's going to extend in to January of 2025. Plus, they get 3.5 more months. So their tax return is not going to be due till, if my math is right, sometime in April of 2025. That's their 2023 tax return. And they don't have to pay until then. So they don't have any interest or penalties, and they don't have to pay until they file that return. That does remind me, by the way, if we go backwards here for a moment, the disaster area exception, there is no date given here. They don't tell you when it's extended until, and that's because the IRS they'll make an announcement, a public announcement on their website and they'll do a press release, and they will come out and say that people who are in this disaster area in these states or these zip codes or whatever it is will get an extension of time until, and then he will name a date because it's just going to depend on the circumstances. But for the combat zone, we have a defined amount of time for that extension. What if somebody does not file on time? So you don't file when you're supposed to file, and we'll talk mostly about people who don't meet those exceptions that we just talked about. So it's due on April 15th. You didn't file by April 15th. You didn't file an extension on April 15th. So you failed to file. Or this could be you did file an extension, which would get you to October 15th, but then October 15th came along, you didn't file by October 15th. So you get a failure to file penalty. It is 5% of the balance due per month or part of a month, up to 25% of the balance due. So if you owed $1,000, they would charge you 5% of that, which, if my math is right, is $50 per month or part of a month, up to $250 total, because that's 25% of the $1,000 that you owe. So they're going to charge you 5% a month for 5 months, or a portion of a month. So it could be 4 months and one day. They're going to charge you 5% 5 times, so 25%. If there was fraud involved, it ups the penalty. 15% of the balance due per month or part of a month, up to 75% of the balance due. If the return was filed more than 60 days late, then the penalty will be the smaller of $450, or 100% of the unpaid tax. If you extended your return, but you still didn't file by the extended date, like we talked about, then the penalties start back on the original due date. So if you were supposed to file by October 15th because you filed an extension, but you didn't file by October 15th, the penalties are going to start back on April 15th. If there is no balance due, then there's no penalty. So if you owe the IRS money, or if it's a zero, you don't owe and you don't get a refund, then there is no penalty. They're only charging it. I guess they figure if they've got your money and you're not asking for it back, then they are not going to charge you a penalty for not filing on time. Failure to pay penalty. If you fail to pay your money, so maybe you filed or maybe you didn't, but either way, if you didn't pay by the due date, then the penalty is 0.5% of the balance due per month or part of a month, up to 25%. So that $1,000, 1% of that would be, I think, $10. So 0.5% is $5. So that would be $5 per month or part of a month, up to 25%. So that can keep going. If you don't pay, that can keep going all the way up to $250, that $5 per month. If you extend and you do make a payment, so you remember we said you have to make an estimate if you file an extension and you're going to owe. If you paid at least 90% of what ended up being due, then they won't charge you any penalty for failure to pay. So if you thought, oh, I'm going to owe $1,000, and you ended up owing $1,100, well, $1,000 is more than 90% of $1,100, and so therefore they're not going to charge you a penalty for failure to pay. They're going to basically said you did your best and it was close enough if you paid in at least 90%. Again, if there's no balance due, then there is no failure to pay penalty. Sometimes you're going to owe both penalties, both failure to pay and failure to file. In that case, the failure to file penalty is reduced by the failure to pay penalty, which basically means you're just going to end up owing the failure to file penalty. It's going to be capped at 5% per month if you owe both penalties. The greater than 60-day rule does still apply, that the penalty is going to be the smaller of $450 or 100% of the tax due if your return is more than 60 days late. Interest. Remember, you're going to have interest and penalties. So interest is charged on the tax you don't pay by the due date of your return. It's charged even if you get an extension of time for filing. It is charged on the penalties as well. So if you didn't pay, or you paid late, or you filed late, and you get penalties for those things, interest will be charged on the penalties as well as on the tax. So they're really getting you here. If you got a large amount due, it can really add up because you're paying interest on the tax and you're paying penalties and you're paying interest on the penalties, and those rates compound daily. So you're going to want to know this for the exam. They're going to probably ask you the interest rates compound: A, annually; B, quarterly; C, monthly; D, daily, or something like that. They compound daily. They are updated quarterly. So they're posted on the IRS's website each quarter. They're based on the federal short-term rate. The interest can be forgiven if the delay was due to IRS error or the delay was their fault. We'll talk a lot more about that in part 3 of this series, but for now, just know that it is possible for the interest to be forgiven. There's one other penalty that we need to make sure we talk about. That is the penalty for perjury, knowingly filing or helping to file a false return or aiding in fraud is a felony. So this applies to the taxpayer and it applies to you. If you are filing or helping to file or aiding in fraud, that is a felony. The IRS wants you to know that, and they are likely to ask you a question on the exam because they want to make sure that it is crystal clear that it is a felony to file a false return or aid in filing a false return or aid in fraud. So it is a felony. The maximum fine is $100,000 and or up to 3 years in prison. So remember, we looked at the 1040 and there were the signature boxes at the bottom. The taxpayer signs under penalty of perjury. You as the tax preparer sign under penalty of perjury. And this is what that means. So you want to know that for the exam. Now we'll get into the tax returns themselves. The top section of the tax return. This has got the basic information that's needed to file a return. And we're going to go and talk about each of these things in some detail, some in more detail than others. So let's look at the top of the return again. And it's got the name, social security number. It has this other statement up here for the year January 1st to December 31st, 2023, or other tax year beginning such and such a date and ending such and such a date. Don't worry about this. Individual taxpayers, 99.99% of the time, are on a calendar year. So your tax year and my tax year as individuals is almost always a calendar year. Even in the year you die, you treat it as if it were a full calendar year. So for purposes of the EA exam, especially, just forget about this. Always consider it to be a calendar year. Even in the real world, it's you will likely never need to use this in your entire career. So, but certainly for purposes of the exam, forget about it. Everybody is a calendar year. But you've got name, address. Of course, you want to verify people move. This is the current address, not the address necessarily where they were on December 31st of 2023. It is the address where they are now when you're preparing the tax return. Think about it this way. If the taxpayer has a refund due from the IRS, Where do they want them to send the check? Do they want them to send the check to where they live now, or do they want them to send the check to where they lived on December 31st of 2023 if it was different? Of course, they want them to send it to where they live now. So that is the address that you put in here. Social Security number, we're going to go into in more detail. We've got this presidential election campaign box we'll talk about later. Filing status, we're going to talk about later, but here you need to check the box for which filing status you have. We have a digital assets box that we'll talk about. If they're taking the standard deduction, which standard deduction versus itemized deductions will be another video, but at the top section of the tax return, they need to claim, are they a dependent on someone else's return? Or is their spouse a dependent on someone else's return? And if so, does the spouse itemize on a separate return? So they would check one of those boxes. Age or blindness, if you're age 65 or older, you check a box. If you're blind, you check a box. Notice here, the age is on January 2nd of 1959. If somebody, if their birthday is January 2nd of 1959, then on December 31st of 2023, they are actually 64 years old. But they give you this little grace period here. And they say, if you were born by January 2nd of 59, in other words, if you're going to be 65 on or before January 2nd of 2024, they're going to go ahead and treat you as age 65. So that's the way this works. So that's what that means. Then we move down here to dependents. So if you have any dependents, you would put in their name, social security number, their relationship to you, and then you would check these boxes. So now let's start talking about the particulars. Social security number or TIN. So SSN, social security number, or TIN, which is taxpayer identification number. You must have one or the other, social security number or a taxpayer identification number. Most people will have a social security number. It is required for the actual taxpayer or taxpayers on the return. It is also required for all dependents of all ages. Even if it's a newborn, you need to get the social security number before you file the return. The only exception is if you had the unfortunate circumstance of having a child that was born and died in 2023. So they were born in 2023, they died in 2023, then you don't need the social security number. Everybody else needs a social security number. There could be a case where you can't get a social security number. And the only reason for that, well, there's one other reason, but the only real reason for that is if the person is a alien, a non-resident or resident alien, and they're not eligible for a social security number, then they can apply to the IRS for this ITIN, this individual taxpayer identification number, and they can get that. They can also get it for children or dependents on the return. They would get this TIN or TIN. They file Form W-7 with the IRS, and it's just for tax purposes only. They can't use it for any other reason, for identification or anything like that. It's only for tax purposes. Then also, if you're in the middle of adopting a child, but you haven't actually, the adoption hasn't actually finalized yet, that child may qualify as a dependent, but you can't get a social security number for them until the adoption is final. And so you can get an adoption taxpayer identification number for that child. So just remember, everybody's got to have one of these. Everybody who's a taxpayer on the return and every dependent on the return needs to have a social security number unless they are a non-resident or resident alien who aren't eligible for a social security number, or they're a child that you're in the middle of adopting, in which case they would need a taxpayer identification number or TIN. Residency. We've thrown around these phrases here: resident alien, non-resident alien. So what are we talking about? Well, an alien is any non-U.S. citizen. So if you or your taxpayer client is a non-U.S. citizen, they are considered an alien in the tax law. There's three types of aliens: resident alien, non-resident alien, and a dual status alien. And there is also a publication. This was listed on that slide back towards the beginning, but I'm going to list it again here for more information. If you're going to be dealing with this population a lot, then you're going to want to get publication 519, U.S. Tax Guide for Aliens, and study it, because there can be nuances beyond what we talk about here for purposes of the EA exam that you are going to want to be familiar with. But in general, a resident alien is taxed on worldwide income just like U.S. citizens. So if you are a resident alien, you're taxed just as if you were a U.S. citizen. An alien is considered to not be a resident. They are considered to be a non-resident unless they meet one of two tests, the green card test or the substantial presence test. So in other words, the only way you are considered a resident alien is if you pass one of these two tests, the green card test or the substantial presence test. What's the green card test? Well, a green card test is someone who is a lawful permanent resident at any time during the year. And if they are a lawful permanent resident at any time during the year, they will have a green card, technically called a permanent resident card, but it's known as a green card due to its color. So if the person has a green card and they were a lawful permanent resident at any time during 2023, then they meet the green card test. So this is a case where you would want to see that and get a copy of that green card. The other test is the substantial presence test. So this is for somebody who does not have a green card. It is still possible for them to be a resident alien if they were physically present in the United States on at least 31 days during the year. So that would be, in this case, 2023. So if they were physically present in the United States for 31 days during 2023, and they were physically present in the United States for 183 days during the 3-year period that includes 2023 and the 2 prior years. So this would be 2021, 2022, and 2023. They were physically present for 183 days using a special counting method. Then they meet the substantial presence test and they are a resident alien. But it is not just 183 total days in the prior 3-year period. We count it in a special way. You count all the days for 2023. So how many days they were physically present in the United States in 2023, you count all of them. You only count 1/3 of the days that they were present the year before. So that would be 2022. And you only count 1/6 of the days that they were present 2 years ago, which would be 2021. So give you an example. This is assuming the person is an alien. They were physically present in the United States on 120 days in each of the years 2023, 2022, and 2021. You would count all of the days in 2023, so that's 120. You would count 40 days in 2022 because that's 1/3 of 120. And then you would count 20 days in 2021 because that's 1/6 of 120. So you'd have 120 days plus 40 days, that's 160, plus 20, that's 180. So the total for the 3-year period is 180 days. That is fewer than 183 days. And so therefore, you are not considered a resident alien under the substantial presence test for 2023. So even though they were here for 120 days in 2023, they clearly meet this first test, but they were not in the United States for 183 days during the prior 3 years when you count it the way you have to count it for the test. So that is a resident alien. Either they have their green card or they meet this substantial presence test. Non-resident aliens, so that's any other alien that doesn't meet one of those two tests. They are taxed only on their income from sources within the United States, and on certain income connected with the conduct of a trade or business in the United States. So I'm just going to call it as a shorthand, their United States source income. That's what they are taxed on. Remember, a resident alien is taxed just like a U.S. citizen, which means on their worldwide income, no matter where it comes from. If they've got a bank account that earns interest back in France, where they're from, then that counts as income. If they are a resident alien, that counts as income for U.S. tax purposes. If they are a non-resident alien, that does not count as income for U.S. tax purposes. But if they've got a bank account in the United States that has interest, then that would count for a non-resident alien. There's a bit of a special case for a non-resident alien spouse. If a U.S. citizen or resident alien has a spouse who is a non-resident alien, then they can elect to treat that spouse as a resident alien if they want to. And again, the IRS, that's fine with the IRS because the resident alien has to pay tax on all of their worldwide income, and the non-resident alien doesn't. So the IRS actually either breaks even or comes out ahead on that deal. That's why they don't mind if you treat that non-resident alien spouse as a resident alien. So we talked about resident aliens and non-resident aliens. There's this third category, which is dual status alien, which maybe you already guessed, that's a combination of the two. So it's possible to be a non-resident alien for part of the year and a resident alien for part of the year. And in that case, you are a dual status alien. Usually that's either in the year of arrival to the United States or the year of departure from the United States. So for the part of the year that the person is a resident alien, they are taxed on their income from all worldwide sources, just like a U.S. citizen. And what counts is when they received the income, not when they earned it. So if they received the income while they were a resident alien, then it is subject to income tax in the United States, no matter where it originated from. So it's when they received it. On the other hand, if they received it when they were a non-resident alien, it is only taxed if it's from a United States source. If it's from a foreign source, if they received it when they were a non-resident alien, then it is not taxed in the United States. So dual status, if you understand resident and non-resident, dual status isn't that complicated. Resident aliens are taxed on worldwide income. So for the part of the year the person was a resident alien, they're taxed on their worldwide income. Non-resident aliens are only taxed on U.S. source income. So for the part of the year that they were a non-resident alien, they're only taxed on U.S. source income. And so, and what counts is when the income was received. So let's do a little recap. What's an alien? Any non-U.S. citizen. What are the three types of aliens? Resident aliens, non-resident aliens, dual status aliens. How are they taxed? Resident aliens on worldwide income, non-resident aliens only on U.S. source income, and dual status aliens, it's a mixture of the two. And if you want more information, go to publication 519. Next, we will talk about filing status. We've already mentioned them: single, married filing, jointly, etc. So here they are. There's 5 filing statuses. You can see them there, and get used to these initials because through these videos, you're going to see MFJ and HOH and all of these things. It's just a lot easier than writing it out each time. So it's single, married filing jointly, married filing separately, head of household, qualifying surviving spouse. If you've been around a while, you may remember qualifying widow or widower, and they changed that back in 2022 to be a qualifying surviving spouse. If you're Googling, you might sometimes see references to qualifying widow. So just know it's the same thing. They just updated the language. And so we're going to talk about each of these in turn. So first, single. This is for someone who's not married on December 31st, 2023. And so for all of these filing statuses, we always look at what is their marital status on December 31st, 2023. So you could be married all year and your divorce is final on December 31st, 2023. You are considered single for all of 2023. This also includes anyone who was widowed before 2023. If they were widowed during 2023, they're considered married for 2023. But if they were widowed prior to 2023, they are considered not married. So they might be single for their filing status unless they qualify as qualified surviving spouse or head of household. But they are considered unmarried in any case. The next filing status, married filing jointly. So again, if they were married on or before December 31st, 2023, they're considered married all year. Again, even if their spouse died during the year, they're considered married all year. To file jointly, both spouses must agree. So if one spouse says, no, I don't want to, then both spouses have to file married filing separately. Obviously, report their combined income if they're filing jointly and all allowable expenses. They're considered one taxpayer, even though they're two individual people. Both spouses are generally liable for the tax that's due. Can be exceptions to that, but the general rule is you are one taxpayer. Therefore, both individuals are liable for the tax that is due. It is usually more favorable tax treatment than married filing separately. You can use, if you've got professional level tax software, you can usually run it both ways. You can put in all their income and deductions, and then you can say, okay, they're married filing jointly, here's how much they would end up owing or getting back. If they're married filing separate, here's how much it is, and you can compare the two, and almost always it's going to be better from a tax standpoint to be married filing jointly. There might be non-tax reasons that they would want to file separately, but that's just the way it works out. And once you file jointly, this is important, you cannot amend to file separately once the due date is passed. So if you file jointly, once the due date for that return comes and goes, you cannot amend your return to file separately. So if you choose to file jointly, you're stuck with it. That's what we're saying. You cannot amend to file separately. Okay. And again, you should know that for the exam. So now let's talk about married filing separately. Same rule about being married. You are either married on December 31st of 2023 or you are not married on December 31st of 2023. If you are married, then you either have to file jointly or separately, with one minor exception that we'll talk about on head of household. In this case, each spouse files their own return and they only count their own income and expenses, and they are only liable for the amounts on their own returns. It's usually less favorable tax treatment than married filing joint. These people cannot elect to file single. You can't say, hey, we're married filing separately, I'll just choose to file single. That's a no-no. You cannot do it. But you can amend to file jointly if you decide later you want to file jointly. If both spouses decide that they want to file jointly, they can do that as long as they do it during the normal amendment period, which is usually 3 years from the original due date of the tax return. So remember, if you're joint, you cannot go back and file separately, but if you file separately, you can go back and amend that return to file jointly. Head of household. This is a special status. The stereotypical person who would file head of household is a single parent. So they've got one or more children. They are not married. They would be head of household. Now, it doesn't have to be a child, and we're going to talk about that at some length coming up. But that's the stereotypical example. So if you're thinking of it in your head, think of the single parent who's got the child. They need to either be married or considered unmarried on December 31st. So put that considered unmarried on hold for a minute. We'll talk about that. So they're unmarried on December 31st, 2023. They have to pay more than half the cost of keeping up a home for the year. A qualifying person has to live with the taxpayer in the home for more than half the year. We don't count against them temporary absences for such as going to school. So for instance, if it's a child who's in college and they live somewhere else out at school, but their actual home is still the home of the parent. So we don't count that time at school against them. So they're still considered to live with the parent, in other words, as long as the parent's home is their official residence. Now, if the qualifying person, remember what we said, it doesn't have to be a child of the taxpayer. If the qualifying person is actually the parent of the taxpayer and they're a dependent of the taxpayer, then they do not have to live with the taxpayer. So if it's anyone other than a parent, that person has to live with the taxpayer for more than half the year. If it is the taxpayer's parent who is a dependent of the taxpayer, they do not have to live with the taxpayer. So in other words, they might live in a nursing home, and that's fine. You can still take them and treat them for head of household purposes. So head of household is a better tax rate than single, but not as good as married filing joint. So it's kind of an in-between status because you're not married, you're unmarried. So you are single, but you've got this qualifying person living with you. So the IRS is giving you a little bit of a break. Not quite as good as if you were married filing jointly, but at least it's something. So let's now talk about that considered unmarried thing. What does that mean, considered unmarried? Well, it's a very narrow circumstance. You have to meet these very specific criteria. You have to meet all of these criteria. You have to file a separate return from your spouse. You have to have paid more than half the cost of keeping up the home. Your spouse cannot have lived with you for the last 6 months of the year. And here, the temporary absences work in the other direction. It can't just be that your spouse was away on a business trip for the last 6 months of the year. They have to have a separate residence from you for the last 6 months of the year. Then your home or the taxpayer's home has to be the main home for their child, their stepchild, or their foster child. So the parent doesn't count. Any other relative doesn't count. For purposes of being considered unmarried, it has to be their child, their stepchild, or their foster child. Okay? Remember, this is a different test from the general head of household test, which it could be someone other than your child as a qualifying person. But to be considered unmarried, it has to be your child. Then the last test is that the taxpayer must be able to claim that child as a dependent. Now, it could turn out that they don't actually claim them as a dependent because of some special rules that we're going to talk about later. There's tiebreaker rules, but as long as they were qualified to claim them as a dependent, then it does count for being considered unmarried. Next thing we need to define is the cost of keeping up a home. We saw that they have to pay more than half the cost of keeping up a home. What do those costs include? Rent, mortgage interest, real estate taxes, homeowners insurance, repairs, utilities, and food eaten in the home. So it's all the things related to the home itself plus the food that's actually eaten in the home, not dinners out. It does not include clothing, education, medical treatment, vacations, etc. All of those things might be considered support for a person that we'll talk about later when we talk about dependents. But for purposes of what we're calling keeping up a home, those things do not count. So now we're going to talk about who is a qualifying person. Who is a qualifying person? There's three categories of qualifying people for head of household status. It could be a qualifying child, a qualifying parent, or some other relative. Child, parent, or some other relative. If the person is a qualifying child, which can also include a grandchild, who lived with you for more than half the year and meets the other tests, if that child is not married, then they are automatically a qualifying person. So if they're your child and you meet the other tests, if they are not married, they are automatically a qualifying person. If they're married and you can claim them as a dependent, then they're also a qualifying person. If they're married and you cannot claim them as a dependent, then they are not a qualifying person. So almost always, if that person is your child or your grandchild, you meet the other tests, then they are a qualifying person. If the qualifying relative is your father or your mother and you can claim them as a dependent, then they are a qualifying person. If you cannot claim them as your dependent, they are not a qualifying person. And notice they do not have to live with you. Remember, we talked about that. If they're your mother or your father, they don't have to live with you. As long as you can claim them as a dependent, they are a qualifying person. If the qualifying person is some other relative other than your mother or your father or a child, then if they lived with you for more than half the year and they are related to you in this special way, they're on this special list that we're going to talk about later. The list is called relatives who don't have to live with you. That's just a name for the list. Don't get hung up on the don't have to live with you part. So if they lived with you for more than half the year, they're on this list, and you can claim them as a dependent, then they are a qualifying person. Now, the rest of these boxes here are they are redundant because all they're saying is if they didn't live with you for more than half the year, they're not a qualifying person. Even though we already said up here they have to live with you for more than half the year. This one just says if they're not on this list, this special list of relatives, then they're not a qualifying person. But of course, we already said that up here. And then the one down here just says if you can't claim them as a dependent, they're not a qualifying person. But we already said that up here. You have to be able to claim them as a dependent. So just know what's in this top box and you've got it down. So those are who are qualifying persons for head of household status. Next, qualifying surviving spouse. This is designed for a widow or widower with at least one dependent child. It allows the married filing joint tax rates and standard deduction, etc. It applies for the 2 years following the year of death. So if the person died in 2023, they would not be a qualifying surviving spouse. Why? Because they would file as married, either married filing jointly or married filing separately. Usually they would just file as married filing jointly for 2023. But then they would qualify for surviving spouse if they meet the criteria in 2024 and 2025. So what are the criteria? First of all, they have to be entitled to file a joint return with the spouse in the year of death, even if they chose to file separately. So as long as they were married in 2022, essentially, then they qualify. As long as they meet the rest of the criteria. They have to meet all of these criteria. The spouse had to die either in 2021 or 2022 and not remarry by the end of 2023. So remember, they only get this for 2 years following the year of death. Therefore, they must have died either in 2021 or 2022. And if they've gotten remarried in the meantime, then they don't qualify for qualifying surviving spouse. They have to file married filing jointly or married filing separately with their new spouse. They also have to have either a child or a stepchild who they can claim as a dependent. Or they could have claimed as a dependent except for these special circumstances that come up. So just think about it as they had a child that they could claim as a dependent. That's what you need to know for the exam. And the child had to live in their home for the entire year. And again, we don't count temporary absences against them. That would include school, that would include staying at grandma and grandpa's house. Those things don't count against them as long as the taxpayer's home is that child's home for the entire year. And they had to have paid, the taxpayer has to have paid more than half the cost of keeping up the home. So if they meet all those criteria, then they are a qualified surviving spouse. So looking at all of the different filing statuses, all 5 of them, they are in order as most beneficial to least beneficial from a tax standpoint. Married filing joint and qualified surviving spouse are really essentially the same, then head of household, then single, then married filing separately. So you kind of want to know this order because sometimes a taxpayer is going to come in, they're going to qualify for more than one, and you're going to want to know what to advise them. So, for example, if they qualify for both qualifying surviving spouse and head of household, you would choose qualifying surviving spouse. If they qualify for both head of household and single, you would choose head of household. If they qualify for both head of household and married filing separately, you would choose head of household. Married couples are usually better off married filing jointly. So if you're just really looking at taxes, again, you can run it both ways with your software, but almost always it's going to come out from a tax standpoint as better, married filing joint. But there could be non-tax reasons that they want to do it. There are certain student loan repayment programs that only look at the income of the person with the student loan. And if you file separately, they only look at that income. And if you file jointly, they look at the combined income. So the person might be able to save more money on their student loan payments than it costs them in tax to file separately. So they may choose to file separately. Could be that one spouse is taking very aggressive tax positions or committing outright tax fraud, and the other spouse doesn't want to be responsible, so they choose to file separately. The spouses could be going through a divorce, or they just don't trust each other, so they choose to file separately, or they just want to keep their finances separate for their own reasons, and that's perfectly fine. Again, both spouses have to agree to file jointly. So if one of them says, no, I don't want to, then they have to file separately. Let's do a couple of examples. Carol was divorced in 2022. She's got 2 children with her ex-husband. In 2023, the children lived with her more than half the year. She paid the costs of maintaining the home. But per the divorce agreement, David gets to claim the children as his dependents. Does Carol qualify for head of household filing status? What do you think? Does the fact that David can claim the children as the dependents and Carol cannot, does that change anything for Carol from a filing status standpoint? And the answer is no. Remember, as long as they qualify as her dependents, then she can be head of household even if she doesn't actually take them as a dependent. They certainly do qualify as her dependents, so she can claim head of household status. Example 2, Eduardo's wife Maria died in 2022. In 2023, he's still single. He's raising his 2 young children alone. He's paying all of their expenses. He's claiming them as dependents. He is unmarried and he's providing a house for the children. So a friend of Eduardo's advises him to file as head of household. Should Eduardo follow his friend's advice? What do you think? Well, head of household is definitely better than single. So that kind of would make sense there. But as I'm sure you've already figured out, there's another filing status that Eduardo may qualify for, qualifying surviving spouse. So let's think about it. His wife died in 2022, so that's good. He gets it for 2 years following. So 2023, that would count. He's still single, hasn't gotten remarried. He does have his 2 children, and he's paying all the expenses, and he's claiming them as dependents. Sounds to me like he qualifies for qualified surviving spouse. So Eduardo should not follow his friend's advice. He needs to find a good enrolled agent to do his tax return who can give him good advice, which is to file qualified surviving spouse. Now we'll move on to dependents. We've talked a lot already about dependents and about whether or not someone is a dependent. So let's define it. what does it mean to be a dependent? The term dependent means a qualifying child or a qualifying relative. It actually seems like a pretty simple term, a qualifying child or a qualifying relative. As you'll see, it's a lot more detailed than that. But just know that it does not include housekeepers, maids, or servants who work for the taxpayer. And yes, there are people who tried to claim those types of people as dependents. That's why they have to be clear that they are not dependents. They have to be a qualifying child or a qualifying relative, even though those two terms may not always mean what you would think they would mean from the simple language involved. So here's another chart from publication 17, and we're going to zoom in. So it's going to start by telling you some examples of people that you cannot claim as a dependent. You cannot claim any dependents if you could be claimed as a dependent on somebody else's tax return. Okay? If you or if your spouse filing jointly can be claimed as a dependent on someone else's tax return, you cannot claim any dependents. Now, there is this one little exception, and that is that the only reason you filed a tax return was to get a refund of amounts withheld or estimated payments made. So if you could be claimed as a dependent on someone else's return, but the only reason that someone else files a return is to get a refund of income tax withheld or of estimated taxes paid, then you can still claim dependents. But that's a very rare exception. So the general rule you will want to know is that you cannot claim any dependents if you can be claimed as a dependent on someone else's tax return. You also cannot claim any married person who files a joint return as a dependent. So if the person is married filing jointly, you cannot claim them as a dependent. And again, there's this exception unless the only reason they're filing that joint return is to get a refund of tax already paid in. But again, the rule you want to remember is if someone is married filing jointly, you cannot claim them as a dependent on your tax return. You cannot claim a person as a dependent unless they are a U.S. citizen, a U.S. resident alien, a U.S. national, or a resident of Canada or Mexico. And you cannot claim a person as a dependent unless they are a qualifying child or a qualifying relative. Because remember, that's the definition of a dependent, is that they are a qualifying child or a qualifying relative. Therefore, they have to be one of those two. So what is a qualifying child? Child must be your son, daughter, stepchild, foster child, brother, sister, half brother, half sister, stepbrother, stepsister, or a descendant of any of them. So they don't have to actually be your child. Could be your brother or your sister or a descendant of any of them. So that's the first part for being qualifying child. Next, they must be either under age 19 at the end of the year and younger than you. So if it's your brother, they have to be younger than you. Or they have to be under age 24 at the end of the year and a full-time student and younger than you. Or they have to be permanently and totally disabled, in which case it doesn't matter how old they are. So the main rule to remember is they have to either be under 19 or under 24 and a full-time student. That's the key rule to remember that's going to apply most of the time. And then you've got these other subtleties that could come into play. The next rule is they must have lived with you for more than half the year. And again, we don't count temporary absences against them. The next rule is the child must not have provided more than half of the child's own support for the year. Okay? They cannot have provided more than half of their own support. And the last is they must not be filing a joint tax return. Again, this got that exception unless they're only filing to get a refund of amounts paid in. But the general rule is they can't be filing a joint tax return. So to be a qualifying child, remember there's two categories of people that qualify to be a dependent: qualifying child, qualifying relative. To be a qualifying child, they need to be your child or one person in this category. They need to be under 19 or under age 24 and a full-time student or permanently and totally disabled. They must have lived with you for more than half the year. They must not have provided more than half of their own support, and they must not be married filing jointly. To be a qualifying relative, first of all, they cannot be your qualifying child or anyone else's qualifying child. So if, let's say, you're divorced, they're not your qualifying child, but they are the qualifying child of your ex-spouse, then they cannot count as a qualifying relative. Secondly, they either need to be related to you as on that special list that we keep referring to, that we will talk about. So they either need to be related to you in a way that's included on that list, or they must have lived with you all year as a member of your household, and your relationship must not violate local law. What does that mean? That means a qualifying relative doesn't necessarily have to be related to you, because they either have to be related to you or they must have lived with you as a member of your household for the entire year. So even if they're not related to you or they're not related in a way that's on that list, as long as they lived with you all year as a member of your household, they count as a qualifying relative, as long as you meet all the other tests. The next test is that the person's gross income for the year must be less than $4,700. And the last test is you must provide more than half of that person's total support for the year. Remember, if they are a qualifying child, you do not necessarily have to provide more than half their support. The only rule is that the child must not have provided more than half of their own total support. But if it is a qualifying relative, then the taxpayer must have provided more than half of that person's total support for the year. Finally, you say, we get to that list we keep talking about, relatives who don't have to live with you. So this is that list we've been talking about all the time. The relative has to be on this special list. This is the special list. It might look a bit busy and complicated, but when it breaks down, it's not all that difficult. They have to be your child in one fashion or another, or a descendant of them, for instance, a grandchild. So you got to be your child or your grandchild. Or they could be your sibling in one fashion or another. Or they could be your parent. Even a step parent counts. Or they can be your grandparent, not a step grandparent, but they could be your grandparent or other direct ancestor. They can be a niece or a nephew. They can be an aunt or an uncle. They can be an in-law, a child-in-law, a parent-in-law, a sibling-in-law. And any of these relationships, once established by marriage, do not end by death or divorce. So, for purposes of this list, once the person is, for instance, your stepchild, they are always your stepchild. Once they're your mother-in-law, they're always your mother-in-law. So again, if you look at it big picture, not that tough. Child or grandchild, siblings, parents and grandparents, even step parents, nieces and nephews, aunts and uncles, and children-in-law, parents-in-law, siblings-in-law, all of those count. Support test. When we talk about a qualifying relative, remember we said they got to support, you have to provide more than half the support. We also said that for a qualifying child, the child cannot provide more than half of their own support. So what does that mean? It's the total support includes food, lodging, clothing, education, medical and dental care, recreation, transportation, and similar necessities. So when we're talking about support, we're talking about all of those things. The lodging is based on fair rental value. So, in other words, how much could they go out and rent a similar accommodation for in the area where you live? And the relative's own income and funds only count toward their support if they actually use it for that support. So they could have $1 million in the bank, but if they don't use it for their own support, it doesn't count towards their own support. So let's do a couple of dependent examples. George's wife, Marilyn, died in 2021. In 2023, Marilyn's mother, Mabel, so this is George's mother-in-law, lived with George, and he provided virtually all of her financial support. Her only income was $4,000 in Social Security, which she donated to her church. Can George claim Mabel as a dependent? So, is Mabel a qualifying child? No, she's not. Is she a qualifying relative? Well, she's a mother-in-law, or she was a mother-in-law. We know that, and the mother-in-law counts, but George's wife died 2 years ago. So is she still his mother-in-law? Well, we know the answer is yes. Death does not change the fact that she is George's mother-in-law. Does he support her? Yep, provides virtually all her support. He lives with her. We already said that. Does she have more than $4,700 of gross income? Nope, it's only $4,000, and she doesn't use that to support herself. She donated it to her church. So yes, George can claim Mabel as a dependent. She is a qualified relative. Example 2, Patrick and Irene have healthy twin sons living at home, John and Joe. They're 20 years old. They're single. Patrick and Irene support them. John's a full-time college student. He earns $15,000 at a part-time job. Joe is unemployed. He's not in school. He only earned $1,000 a house sitting for some friends while they were on vacation. Maybe Patrick and Irene need to have a sit-down talk with Joe about what he's going to do with his life. But in any case, it is what it is. Can Patrick and Irene claim John as a dependent? John's a full-time college student. He earns $15,000 a year at a part-time job. He's 20 years old. Is he a qualifying child? Well, it seems like he is. He's over 18, but he's a full-time student. He's under age 24. And he lives with Patrick and Irene, and they support him. The fact that he earns $15,000 at a part-time job really isn't relevant because we've already said that Patrick and Irene support him. So he's not providing more than half of his own support. So yes, they can claim John as a dependent. What about Joe? Joe is over age 18, so he's age 20. Remember, it's age 19 or older unless you're a full-time student, but he's not a full-time student, so he's too old. So is Joe a qualifying child? And the answer is no. He is not a qualifying child because he's over age 18 and he's not a full-time student. So does that mean they cannot claim him as a dependent? Well, remember, there's two different ways to qualify. So we need to see, does Joe count as a qualified relative? Well, first of all, he cannot be a qualifying child. Is he a qualifying child? We already established he is not a qualifying child. So we're okay there. So then the question is he a qualifying relative? Well, is he on the list? Well, yes. Remember that special list? The first thing listed is the child of the taxpayer. So he is a child of the taxpayer. He's not a qualifying child, but he is a child of the taxpayer. So he's on the list of relatives that count. Did he live with them? Yes, he lived with them. Did they support him? Yes, they supported him. Did he earn more than $4,700? No, he didn't earn more than $4,700. Does he qualify as a qualifying relative? Yes. Therefore, Patrick and Irene can take Joe as a dependent as well as John. Next topic, multiple support agreements. So this is usually the stereotypical case here would be elderly parents who are being supported by their adult children, more than one of their adult children. So when two or more people provide for the support of a qualifying relative, the parties can agree that any one of them who provides more than 10% of the support can claim that relative as a dependent. So, for instance, you've got three adult children supporting an adult parent. They each provide 1/3 of the support for that parent. They can agree that one of them can take that parent as a dependent. Now, one person can only be taken as a dependent once. They can't be taken as a dependent by all three of the children. But what the children can elect to do is to rotate so that one year, one child takes mom as a dependent, the next year the other child does, and the next year the third child, and then back to the first child. So they can certainly agree however they want. They don't all three have to rotate. Maybe they decide that two of them are going to rotate. It's completely up to them, whatever they agree to. It's just that the other children have, or whoever, the other people who are helping to support the person must sign this consent form, Form 2120. What about divorced or separated parents? Usually the custodial parent claims the child, and the custodial parent is the one the child was with for the greatest number of nights during the year. That's how they look at it, is number of overnights. So the custodial parent in general claims the child unless the custodial parent agrees to let the non-custodial parent claim them. In order to do that, the custodial parent has to sign this Form 8332, a statement similar to that form that says, I understand that I am entitled to this, but I'm letting the non-custodial parent claim the child instead. And then the non-custodial parent attaches that form or statement to their tax return so the IRS can see what is going on. So in this case, the non-custodial parent gets to claim the child as a dependent, which these days, what that really means is the importance of that is the non-custodial parent gets the child tax credit. Um, Used to be there was an exemption for each dependent that you had, but as of right now, that could come back again, but as of right now, for 2023, for purposes of this exam, there's no dependency exemption. So what that parent gets is the child tax credit. But that does not qualify the non-custodial parent to file as head of household or to get dependent care benefits or credits or to claim the earned income credit. The custodial parent still gets those things. The only thing the non-custodial parent can get, if the custodial parent agrees, is they get the child tax credit. What if a person is a qualifying child of two or more people? So maybe it doesn't have to be the parents. It could be that both parents qualify, or it could be a parent and someone else, maybe a grandparent or an aunt or something like that. But what if a child is the qualifying child of two or more people? The first thing to know, and we already talked about this, is only one person can claim a particular child or a particular person as a dependent. But in particular for children, only one person can claim them for purposes of the child tax credit, out of household, child care expense credit, exclusion of income for dependent care benefits, and the earned income credit. So both parents can't claim the child, even if both parents happen to qualify for the year. So in that case, when you have two or more people who qualify, there are tiebreaker rules. So the first rule is if only one of the people is the child's parent, then the parent wins. So if one of the people is the child's parent, the other person is the grandparent, then the parent automatically wins, and they're the ones who get the child as a dependent. Next tiebreaker, if both parents try to claim the child, then it goes to the one the child lived with for most of the year. So we already said that, the one they're with the most overnights gets the child. If that's even, they're with both parents equally through the year, then the parent with the higher adjusted gross income wins. Okay? Higher adjusted gross income wins if it's a tie on the number of nights that the parents have the child or the children. If neither parent can treat the child as a qualifying child, so maybe the two people that are competing here for claiming the child as a dependent are grandparents on either side, then it's the person or the taxpayer with the higher AGI. So you got grandma and grandpa on one side, you got grandma and grandpa on the other side. Whichever of those two has the higher adjusted gross income would claim the child as a dependent. If no parent claims the child, then the person with the highest AGI wins. But there is a proviso here. That is, as long as their adjusted gross income is higher than any of the parents who could claim the child. Now, you might be saying, what are they talking about? This sounds convoluted. The IRS is trying to keep people from playing games. So you could have a case where one of the parents could claim the child, but they make a lot of money. And if they make too much, quote unquote, too much money, there is such a thing. But if they make a certain amount of money, a high earnings, then the child tax credit will do them no good, or it will do them very little good. They won't really get any benefit from the child tax credit. So what some high earning taxpayers might try to do is to say, well, I won't claim them as a dependent. We're going to let grandma and grandpa claim them as a dependent. Therefore, they can then get the child tax credit. And maybe grandma and grandpa actually give that $2,000 child tax credit back to me. So the IRS says, no, no, no. If any of the parents could have claimed the child and their adjusted gross income is higher, then the parent has to claim the child. You can't just give the dependent to someone else for tax purposes. And now our last topic in this video, and it's a short one, so we're almost there, is the check boxes. We already talked about these. We saw these when we looked at the top of the 1040. There's the presidential election campaign checkbox. It says, check here if you or your spouse, if filing jointly, want $3 to go to this fund. Checking a box below will not change your tax or your refund. So this does not add on $3 to your tax or to the amount you owe, and it doesn't subtract $3 from your refund. It's just saying that I want $3 of my taxes to go to this presidential election campaign fund. If you leave it blank, then the $3 will not go to the fund. If you check it, $3 will go to the fund. It is completely up to the taxpayer. In the real world, rarely is this box checked. Okay, but if the taxpayer wants to, they certainly can. The other check box is about digital assets. So the IRS is trying to figure out what to do about all this Bitcoin and these tokens and all of these virtual assets. And so they're trying to get a handle on it. And they want to make sure that taxpayers are reporting any gains or losses that they have from transacting in these digital assets. So they've got this checkbox, and it must be answered yes or no. At any time during 2023, did you A, receive as a reward, award, or payment for property or services, or B, sell, exchange, gift, or otherwise dispose of a digital asset or a financial interest in a digital asset? And you must check either yes or no. And obviously, you have to be honest, just like everything on your tax return. If you check no, and the truth is you did, then you have filed a false tax return. You got that whole issue about it being a felony. Remember, you're signing that return under penalty of perjury. And if you, as a tax preparer, know about it, again, you don't have to dig into it. If they tell you they didn't, you don't have to tell them to prove. I'm not sure how they would prove they didn't receive any digital assets, but you don't have to have them prove it or anything like that. But if you know that they did and they say, no, I didn't, then you don't want to be signing that tax return. You need to have a talk with the taxpayer that says, hey, look, I know you. I know that you did this. We need to say yes here. And they either need to agree to do that or they need to find a new tax preparer. You do not want to be involved with that. So that's the check boxes. That's the top of the tax return. And so that means that is the end of video 1. I will see you on video 2.